Hello and welcome back to this new episode of Your Next Trade. Today we're going to be looking at CPI or FTXed. So what we had at the start of this week is the big noise about the cryptocurrencies with the FTX bankruptcy, which took a bit of time, started on Monday as we can see later, and unfolded over 5 days. So literally we went from 16 billion net worth for the CEO to zero and actually probably sitting on many liabilities. And on Thursday onwards, we had the big news on the CPI, so which created a massive rally across asset classes, whereas we're going to see indexes, stocks indexes, currencies, bonds had a really big move over 2 days. So quickly looking at the week-to-date asset performances, you probably know the picture if you've been trading the market. Very good week for most asset classes. If we look at the left-hand side of this table, where we got the S&P up 5.9%, Nasdaq up more than 8% on the week. Only the Brazil was weak on this week after the election. There's a bit of uncertainties. And you can see as well, very important, so far we had a strong dollar. So we had the king dollar until the start of October, I will say. And since then, dollar has been hovering at high level, but actually we had a big move on the downside for the US dollar this week. So the DXY is down 4%. As you know or you don't know, the DXY is 55 to 60% euro dollar. So you can see that the move is more or less the same, around 4% on the downside for the US dollar. Same against the Japanese yen, where the Japanese yen strengthened by almost 6%. So the Bank of Japan, Kuroda, must be pretty happy. It's now trading below the 140 level. You remember that they intervened at 145 and above when it was around the 150 and above. So actually, Bank of Japan is breathing a bit again. On the other end of the spectrum, in yellow here, we get the cryptocurrencies. So crypto, really bad week around the space. As I've been saying for years, and I know that many people come back at me and say, look, Greg, you're too old, you don't understand anything. I've been saying, and I'm on tape, on record, saying, crypto, there's a big risk, which is your counterparty risk. One of the worst risks you don't want to have when you're holding an asset is your counterparty risk. If you've been through Lehman in 2008, 2009, if you've been to MF Global in 2012, you know that it's very important to where you're holding your money. I know that some of you, the new generation, think that everything is bad with the banks, with the fiat money. But I guess now what is pretty funny is you see many people asking for regulation. So for years and years they say we don't want to be regulated, and now that they're losing money they want to be regulated. So I can tell you that from someone who worked 13 years ago for Bernard Madoff. So I've known, like in a bad way, how strongly it can hit you. And doing your due diligence, looking at where you hold the money, and that is the downside so far of the crypto space. And that is one of the reasons, obviously, this week has been eaten badly. Let's look now at more positive, looking at the week-to-date industries performances. Left-hand side, this is the US dollar. So, US dollar, most Your Next Trade sessions that we did in the past, it was on the right-hand side of the spectrum. But yes, bad week for the US dollar, meaning a huge risk-on week that started from Thursday onwards. So only a couple of sessions. So this is only 2 sessions, but pretty strong. The other industries that underperform are the defensive ones: the health sector, utilities, healthcare, energy, pharmaceutical. So actually that was not necessarily, so the underperformance started on Thursday, but literally yesterday on Friday, a lot of those defensive sectors went down quite a lot, between 3 to 6% in Europe and the US, or even more. And for the big moves, we got the gold miners, we got the semiconductors. So semiconductors, if you want to look, is the SOX index or the SOX ETF. Actually on Thursday was up more than 10%. So really good day for many industries, way above the S&P 500. If we look at another asset class, which is rates, which is bonds, which are normally the leading indicator of the equity market, even if as an equity trader I don't necessarily like it. What you can see is the week to date yields are down, meaning bonds are up. So if you look at the US 10 years, we had a move of 35 bips. So we went from roughly 4.15% to 3.8% at the close on Thursday, because yesterday bonds were closed in the US. And actually, if you look at Europe, there was a bit of pulling back yesterday from the post CPI number. So we almost gave away on the Bund, on the BTPs, most of the move on Thursday. So this is really something to follow up. I think there has been a bit of unknown of where the bond will be trading onwards. But I think what is important as well is you're going to see many people on Twitter that's going to tell you, or when I say Twitter, that's going to tell you that we are out of the woods, that it's fine, it's going to be a soft landing, that the earnings season was good. So let's discuss first about the soft landing. What the market is still pricing, if you look at the 10 versus the 2 years, we are still pricing here minus 50 bips. In other words, the bond market is very much pricing a recession coming into the US, and it's not very different from what we had 1 month or 2 months ago. So on that part of the yield curve, there is not much of an improvement. If we talk about the earnings season, as we're going to see later, the earnings season was not that great either. So looking now at the Fed expectations, where do we see the Fed in the near future? Because this is very important. As you know, over the last 3 months, there have been talks and ongoing about the Fed pivoting. By definition, if the terminal rate, which used to be in March, which is now in June, not very different if you look at the euro dollar, so that's a differential. So more or less, between March and June, we might reach the peak in the Fed cycle. If you think about it, as I said before, it's 5 to 6 months from now. In other words, as a trader, as a portfolio manager, you're looking 6 months forward, 3 to 6 months forward. So a lot is priced in now. The question that we have now is, if we want for stocks to go lower, if we want bonds to move differently, we need to have a recession, a harder recession. We still don't know how hard this recession and how the effect of inflation and the central bank's activity will affect the economy. But what we can see from 1 week to another, so if you look at last Friday on the 4th, between Friday yesterday, you can see a big change on the Fed expectations. If you look at the March, so that's the June here, sorry. So if you look at the June, we moved more or less by the Fed. The market is now expecting the Fed to do 25 bips less, 0.25% less in the rate hiking. And if we look more interestingly at the December, you can see that it's a 40 bips. So that's quite a big change, which obviously you can do this. You can see it's getting bigger and bigger. But based on these CPI numbers, this is what the market has been pricing from the rates. On the volatility side, if you've been watching the Euronext trade previous sessions, we know one of the struggle has been the VIX has not been a very good indicator to look at equity volatility. Why? Because the market is more and more driven by short-dated options. What we can see now is the VIX is now trading at, not trading, but it's pricing at 22.5% roughly. One of the good things for your next trade is when it was trading around the 30, 35, 40%, and that means most of the option monitor was trading at high implied volatility. If you were looking for putting trades, unless you are doing call spread, put spreads, and spread strategies, it was hard to be putting that much big directional position. With the VIX at 22, you can start to be putting position again. So instead of doing cash, you can allocate more strategies to options, because there is the cost due to implied volatility is coming down. If we look at the VIX term structure, it's a pretty now normal one, and there's not much to say. Going now into the technical analysis after looking at the price action. So this is for the S&P. As I told you before, when we were holding around the 3600 for the S&P, I was saying as long as we don't break it, unfortunately there is not much to do. And I thought, and I still want to believe that we're going to go to 3400, 2900 in the next 6 to 9 months. I think the market will realize that the soft landing is not going to be that much of a soft landing. We're going to go lower. But so far, the trend has not been broken. If you look at the direction, there is a good chance now, the 4100, which is close to the 200 moving average, and then you get this resistance. So based on the positioning, based on the seasonality, which is very favorable for stocks until the end of the year, based on a very quiet market, low volume that we can have in the next 2 to 3 weeks, we could see the market moving up another 2 to 3%. Based on that, I'm not holding any directional position. I think to me it doesn't make really sense, the risk reward. I think if we go a bit higher, 4100 something, and if I can find some good strategy with options, I will start to be putting short again. Nasdaq, the picture, the trend is still the same. We're coming down, but is it a breakout? We need confirmation at the start of this week, but it feels very much like people are back to tech. And that was the sum of the story of the week. Russell managed to bounce. We've been looking at it, but similar, it's in a downtrend. The DAX looks a bit better. That I don't know what to think. Actually, it's a bit odd to me, and when I don't understand, I just don't do. Emerging markets. So the China story is helping, a kind of a reopening of China. We have been waiting for the last 2 years for China to reopen. There has been some headlines that they are still going to have a hard COVID policy, but it's going to be more targeted. Why? Because the Chinese economy has been slowing so much, then they need to do something. So EM, most of the EM is around China, so you're going to be holding a lot of Chinese exposure. One of the sectors that I'm really looking, or industries, is the Philadelphia semiconductor, the SOX index, which has been struggling on the slowing of the economy, on the fight between China and the US. So now we are at the top of this range. This is something that we really need to be looking at after the big move for the week. XRT, as I said before, that was one of the top that I was watching. As long as XRT is holding, that means what? That means the US consumer is holding. What we're going to see later, it's going to be quite an important week this week for retail due to earnings and due to macro numbers in the US. If we look now at the euro dollar, this one has been pointing out like quite nicely. We broke the range that was on the community. I shared a lot. Now we just reached an important level, which is 1.035. That was really the first move onward. US dollar, Japanese yen. So this is the close to the first target, the 139. Then we might go into, I think it's 130, 133, important level. And then finally going into the oil, CL1. A lot of volatility this week. The trend is still not clear between China reopening, world slowing. We know that the Biden administration has been very actively putting some supply in the market to meet the demand, but now they at the end of this month they will not putting these reserves again in the market, and they will have to buy back what they sell to the market. So that's going to be an interesting story to follow. Going into this week, what happened? So to me and for most of you, it has been the same week, which is the first part was, did you get FTXed? In other words, did you get nicely FTXed by the story around crypto? So it started on Monday when the FTX CEO, so at that time, FTX CEO was supposed to be worth 16 billion, running an exchange market. And he was saying that the assets are fine. He was saying that because there were apparently some rumor that the competitor was saying that it was not safe. Then on Tuesday, they said that they asked for help. and their competitor will name them. Then on Wednesday, Binance, which were the one that put the rumors on the market, then said that they might be looking at the deal, say we are off. On Thursday, the news came out that they were seeking for 9.4 billion, and the story is still ongoing. What we know now that they filed for Chapter 11 bankruptcy. So, and if you look at obviously the crypto world, here we are looking at Bitcoin and Ethereum, we are down 20% on the week. So to me, as a next Madoff employee, I know the story pretty well. It's very similar to Bernie Madoff story, which is if you look at FTX as a business very similar to Bernie Madoff, which was FTX was about running an exchange, and Bernie Madoff was being market maker. So on that side of the business, that was supposed to be safe and making money through commissions, through fees, through the bid offer, through the spread. And then you get another part of the business, which is dealing and trading your own money. And that was the hedge fund for Bernie Madoff, and that was I can't remember the name of the company, FTX of trading, but where you had 10 billion or more of money put on the table, where if you watch those guys trading the money, it was guys in their 20s at Stanford, no stop losses, no risk management or whatever. So what happened is they lost a bit of money, and probably like Bernie Madoff, it's like a Ponzi scheme. They were asking for more money, and they were losing more money. So you need to have new money. And the only time where Ponzi goes down the toilet is actually when there's a lot of redemptions, big redemptions. And that happens when the market is under a lot of pressure. And that happens in 2008 with Bernie Madoff, when you had a lot of redemptions because people were losing a lot of money. And that's the same with FTX. So there are many lessons to learn from that is if someone is running both a business of a borrowing business and a trading business, and most of the risk is on the trading business, you know that you're not safe either for the market making or the exchange. The other thing that you could tell is regulation is good for something, because normally it should be better regulated. But as you can see, with Bernie Madoff, it was supposed to be regulated. It didn't go very well. If you look at MF Global in 2012, it was supposed to be to have a wall between the money of the clients and the trading of MF Global trading BTPs in Italy, and it didn't. Okay, so regulator is better, but it's not always there. That's the downside. And what you learn, and I learned it in 2008, both through the job, losing my job, and literally struggling with the CV, having some money that was under the Lehman and some funds, is counterparty risk is your biggest risk, because this is where you put your money. So that means if your counterparty goes down the toilet, your money, it's going to be hard to recoup your money. So be very aware of this. And unfortunately for crypto, what we learn is, if you sell people to be making 50, 100, 200%, you need to believe either in that something is wrong, or you are completely stupid. And I think that is what happens with most people, is you're greedy. And trust me, for me being in this industry, what is interesting is if you come and you say, I'm going to be raising 1 billion and be making 50% return, it's going to be much easier to say, I'm going to be raising 1 billion with 10% return. The 50% return, people will buy that story. And unfortunately, this is human being. This is the long cycle, and it goes always like this during the cycle. So that was the first part of this week. It's not over for crypto. It's not over for most people that are holding position. Even if it's only 1, 5, 10% of people's net asset, and sometimes it's 100%, but for more developed investors, and I'm not talking people sitting on the beach and pretending that they are all in one crypto. That means that when there is pain, you need to raise money on the other part of your portfolio. So that means you need to sell assets, probably, and that means it's going to be much harder for new businesses to raise money, because the compliance, hopefully, from private equity VCs is going to be harder in the future. We can still hope on that. Next part, the positive part, which was from Thursday onwards on the CPI. So that was due to the better than expected from the CPI. There was some good guys on Twitter warning us that it was probably, so the differential of minus 0.3%, plus 0.3% versus plus 0.5% month on month and year on year, the differential year on year is mostly due to one factor, and it's not going to be seen in the PCE. So PCE is the number data for inflation for the Fed, and that numbers will come at the end of this month. So between now and the end of this month, we got Thanksgiving, we got the World Cup, so we got already low volume. It's going to be even lower volumes going into the end of this month. But I think interestingly, if you're looking at the next catalyst, which is mostly inflation, which is all about inflation, you look at PCE, and this is at the end of the month. So if you think about putting positions, if you think about looking at strategy with options, if you look at options, you almost 20 days. So is it worth piecing away the theta? Those are the questions that you need to ask. China reopening, this is the third question. Is it really reopening? We have so many back and forth with China. And as the Politburo is going for another 5 years of policy, it's hard to believe that suddenly they're going to change the policy. Finally, earnings season is almost over. We're still going to have 10% coming into next week. Finally, I just wanted to show you the asset performances on Thursday. So this is the similar chart that we have normally on the week to date. So big numbers for stocks, we are talking 6%, 5.5% on the S&P, 7% plus on the Nasdaq. That was only on the day. And the currency, we got the dollar 2% down on the day. So think about it, 2% dollar down on the day. Normally, before COVID, from 2010 to 2020, you will have roughly an ATR monthly for the euro dollar around 3 to 4%. So in one day, we did 50% more of a monthly move. What is interesting now is obviously what is your next trade? What is our next trade? Because we've been looking backwards, trying to find out, what could be interesting in the near future. So next week, as always, after the CPI, after the big numbers, we should be looking at the Fed speakers and tell us, and listening to what they're going to tell us. By definition, they're going to tell us, look, guys, we need to be careful. This is only one number. So we're going to go from 18 months ago, 16 months ago. So don't worry, it's very transitory. And every call, they were saying it's transitory, it's fine. And they were not raising rates. And now, as they fucked up a bit, they're going to tell you, don't worry, it's only one number. We need to be careful. So this is all the talks that we're going to have. On Friday, we get the OPEX option expiry after such a big move. There is a possibility, and this is why for the S&P going to 4,100, that the magnets, that the gamma positive, as we are running way above the neutral gamma, that the delta is kicking in, and this is what happened on Thursday and Friday, that we could keep on going higher. So we need to be looking at the Nasdaq. Is the Nasdaq really breaking? Is the tech through the Amazon, even all the dodgy names that suffered so far for the year down 70%. So if you look at the factors and what did very well on Thursday, the best factors, the best industries were the ones that were the most shorted. So we are talking at the stocks. We were talking as well at the short momentum. So the short momentum was more than 12% on the day. So literally you get a massive squeeze. So be careful if you squeeze based on the price action, and as well based on the volume, you could be chasing something way above. So sometimes it's better to be missing the 2, 3, 5% first move against going and pissing against the wind. Interestingly, we get a lot of retail numbers, US retail sales on Wednesday, but as well we get Walmart, we get the Costco, we get Lowe, we get the Target. So where we are in November, we are close to this Thanksgiving period, meaning the Black Friday and the Cyber Monday. So very important to know how the US consumer will be digesting all the inflation. University of Michigan number from yesterday, the picture was not great. So US consumer is still feeling the pain. And that means how both the retail sales and the housing in the US, so the housing number are going to be not great. They're going to be bad. Okay. So be careful about the low liquidity of the World Cup coming. Unfortunately, even if in the US people don't watch soccer as we did in Europe, normally historically the volumes come down quite a lot. So there might be low volume before the PCE, which is on the 30th. Look at the Fed speaker. Look at China. So here I put a chart of USD CNH. China, I think if we want the market to carry on, we still need to have a positive noise coming from China. And one of the proxy to look at it is obviously the USD CNH. So far we had a bit of a move, but versus any other currency, that is not such a big move. Finally, the correlation that we had so far. So here I put the chart since the end of October between S&P futures and the 10-year future, which is, you can still see that there is a massive correlation. So it's a one correlated market without, by definition, not uncorrelation. We need to see how the bond, by how much the bonds are going to be moving, because the market is pretty much driven by bonds. So market should be less active in terms of liquidity and volume. Okay, so be careful of chasing the moves. If we look at charts, 4100 for the S&P is very much possible. I don't think, to me, that there is too much of catalyst until the PCE, and then you're going to have the FOMC meeting where we're now expecting 50 bips. Finally, I just want to talk quickly about the earnings season, where 90% of the companies came with their earnings.
Translation. Falba Lil undergoes routine exams at Syrio Libanus before traveling to COP27.
Bloomberg talking, but earnings season 90%, not that great. Companies not meeting expectation as much as usual, where numbers were downgraded massively. If you look at Q4 expectations year on year, now we expect earnings to come down. Historically, when the earnings are down year on year, this is normal to have the S&P coming down. So there is a strong correlation, unfortunately, between earnings, or fortunately between earnings and the S&P. So I want to believe that earnings will come down, and actually that the expectations are still too high. So if you like more information about the 4x4, you go on the website, or you send me an email at greg@duponttrading.com. I know that there is growing demand for mentoring, because it's very often people will like to start the year January 2023 or any year doing something new. So there is more and more demand for the mentoring. So if you're looking for mentoring, please send email pretty quickly, because we only get 6 to 8 weeks before the start of next year, and now I'm getting less and less seats for next year. This is it for me today. I see you next week, and I hope you enjoyed this session. All the best. Bye bye.